It is good morning. If you guys could be so kind as to let me know you can hear me, the volume's okay. Just give me a 5 by 5. I appreciate it. I'm checking on Twitter. I'm not sure if it feels the same for you, but I feel like I've been away for too long. Man. So, as the title suggests here, I titled today's Shotgun Saturday, Lifts You Like a Feather. And admittedly, as I mentioned this morning, I had a pretty interesting dream, which I'm not going to talk about that, by the way. And I'm sure for the folks that are interested in lucid dreaming and all that, I could probably weave that into another Twitter space of another topic outside of trading, but it's going to be outside the scope of today. But admittedly, it was a heavy influence today because I thought about basically, you know, what is it I want to talk about going into this weekend? I thought about this entire week. I wanted to come up with something that was engaging. I wanted to have something that would be helpful, impactful, and try to promote some kind of well, performance, some kind of improvement, some clarity, that type of discussion today. And a lot of the questions I saw that were coming to me to my video section, where the video section comments area are open, a lot of people asked, like, how do I know when not to trade? And could I talk a little bit about that? And what are the things that help pinpoint those things for you as a student are trying to learn what it is I'm teaching and hopefully try to adopt some of the mindset things that I've acquired over the years that help me to mainly avoid losing, where as a younger man, I was more prone to losing, jumping into these environments. So I will talk a little bit about that today, but understand that it's normal for you as a that commission based commission fees. You have services and softwares that want to try to get a bite of the action as well. And all of those things, all those outside employees before you do. Just like a job, tax man cometh. You can't you can't escape it. Okay, no matter how much money you have, you, some way, shape, or form, if you're buying something, or if you're selling something, if you're acquiring something, or running a business, to some degree, you're gonna pay something in taxes. But in the pursuit of profitable, consistently profitable trading, the common denominator is avoiding overexposure and over leveraging. So risk is not the same. Okay, to eliminate the over leveraging, because it's easier to do that and shorter. Over leveraging is simply adding usually valve and if they're really professionals do 15 contracts when they're only allowed to lose, a couple $1,000. It just completely flies in the face of sound logic. So over leveraging is not what I'm talking about when I say overexposing. So over leveraging is just simply doing too many contracts per trade, opening yourself up to monetary risk that is exorbitant based on the equity base that you're working with. In these conditions, prices are fluctuating. You get a season, it's hunting season. While you used to be able to and chase Bugs Bunny, duck. Everybody's off at the beginning of the week. They're like, "Yeah, man, I'm on me, and I'm gonna take because the markets are trade. This market not being exempt. It's being served up on a dish for like me. Quickly, I didn't try to get through it fast because I didn't understand that it was something to incur or have to go through. too limited in my 20-year-old when I first started. The books didn't talk about this, about following your setups, pushing your edge, trying to do more. Very little was ever spoken about doing the least. And if you think about it, it would be very hard to market that even today. You're going back to the 90s, 1990s for the folks that are millennial. Like my youngest son says, Dad, you're from the 1900s. like it's like centuries ago. But in trading, to get to that point. And some of you are going to fail, not because of the things that you learn from me or anyone else. It's just simply that you're not equipped to do this. And doesn't mean that you're forever ill-equipped. It just means for that moment in time, you may be ill-equipped. And you will have to accept the fact that you will fail on the temporary. Now that stays temporary if you allow it, but it becomes final when you choose it to be. So taking breaks, calling it quitting, whatever, that's normal. I did that. I did it dozens of times as a young man. But overexposing yourself is constantly seeking opportunities and insisting that they're there, forcing them. And because you know that there's a likelihood, there's a potential for the market to create opportunities where it might be big moves this coming week. It might be big moves in this coming trading session. There might be large range expansion days. If you're a commodity trader, we could see limit up or limit down days where the opening is the only fluctuation in price from the previous day's close, meaning that wherever the previous day's close was, when that commodity would start its trading for the day, it opens limit up, the highest it can move, the maximum amount of fluctuation in movement from the previous day's settlement price. It's not allowed to go any higher. And it doesn't trade off that. It just stays there. So when you look at a chart, it just looks like a little hyphen, a little dash. The open and the close is the same price. That's a limit up move, and vice versa. When the market's going down and it's dramatically being repriced, not buying and selling pressure, and that's how you know it's a myth. Buying and selling pressure is a myth. That's not what causes prices to go up and down. Because if that was the case, you're trying to tell me, and I make this argument all the time, a limit up day. It's lock limit up. Okay. Why can't I and why couldn't I sell out of my position? I wanted to take profit. I couldn't. You're trying to tell me that there's not one person out there that were interested in seeing any lower tick to be able to offer one transaction outside of just the opening price being the only price of the day? It's a myth, folks. It's a myth. So all of these ideas keep flooding into your mind as a trader, and you understand that we do this to make money. You might have other subordinate reasons. You want to look smart in front of your girlfriend, and your boyfriend, and their family members. Carl. But the number one thing should be you're trying to make money. And that's a very powerful influence. It's very powerful. It will place you in the pursuit of things that are not really there. You'll chase things that are phantoms, like trend lines. That's why I literally call them trend line phantoms in core content. Because you want this to be a diagonal support level. You need it to be because it provides you the venue on what you're going to act on and say, oh, yeah, this is the time where I want to be a buyer. Because everybody's going to see that area too. And they're going to want to buy too because this imaginary two swing lows, if I extend a line from those two, that imaginary decision point in the future, everybody's going to have that same decision point and want to buy there too. And I capitalize on that. I look for opportunities for those types of things. And when you overexpose yourself seeking opportunities where there may in fact be opportunities there, but you become the liquidity. But you won't see it that way walking in. You won't see yourself laying yourself on the altar of these markets. Sacrificially just laying yourself out there. Consume me, take me, pick me, burn me up. Dismember me. Willingly doing it. But you walk into that condition thinking that you're going to leave in a gain. And the only thing you've gained is experience about not, hopefully, wanting to do that same thing again. And it took a lot of repetition for me to get really displeased with chasing something. Whenever I got really anxious that I was going to miss a move, or if I was really excited about a particular trading week over the weekend, they were the characters that constantly came up in the play that resulted in me losing. Sometimes losing an entire account. Now, I don't know why when people are new, they come here and they want to listen to me or whatnot. And I'm honest with you, and I tell you where I learned from, and it was through pain. It was through adversity and lots of blown accounts. For some reason, that seems to be like a bad thing for you. I would want to learn from someone that has gone through the pain, has lost a lot of money, and learned how to avoid doing that again. That's the person I want to learn from. But unfortunately, that's what I'm trying to tell you many times when I said in this discussion this morning. Talking about how to trade less. If I wrote a book and it titled it Trade Less, nobody's wanting to buy that book. Now there might be a little niche market in there because it's my name on it, and people want to hear what I have to say about it. But by far and large, they're not really going to be interested in it unless you know who I am, and you're already interested anyway in the things I'm talking about. You probably wouldn't be a buyer of that book because what is it telling? It's saying something that is contrary to the consensus that this industry has cultivated, which is always do the most, never relent, maximum effort, to quote Deadpool. And unfortunately, in the 3 decades I've been messing around with these markets, I've learned that less is more. And I've also learned that I was prone to overexpose myself to risks that I didn't understand or could identify as risk because I was falling victim to the things that I purchased in terms of courses and books and people teaching this and that. And because I wanted to change my life, I didn't want it to be the mundane Michael, the average Joe. I was seeking and pursuing something that was bigger than just regular. I didn't want to be the regular guy. And everything that I picked up, I've always demanded it to be exceptional. And I was very disappointed that everything that I purchased and everything that I absolutely worked very hard by their rules, I followed it by their rules, and it would not work. It would not yield to me the results that they promised. It would not yield a consistency and a visibility to be able to see these things forming beforehand. And it caused me to jump into the very next thing, the shiny new object syndrome. And even in this community, because if I teach something new, I talk about something new, everyone's so quick to let go of what they're already working on that they've had progress in and beginning to see the stages of development that hasn't happened fast enough for some of you. And because it hasn't happened fast enough for you and you haven't had a payout yet in a funded account or hasn't seen a profitable live account yield you a withdrawal yet, you haven't got to that stage yet. It's there waiting to be had, but you haven't got there yet. So you're impatient. And it's easier for you to say, well, this looks new. And everybody's going to be talking about this new thing. So I'm going to be distracted anyway. And ICT is going to be jawboning and going on and on about this new thing. So I might as well just go ahead and chase that because who knows? It might become easier. I might be able to get this faster. And faster is a recipe for disaster. And I was a pellet, didn't even know it. The idea of trying to do something quicker for the sake of getting through it. I want to get profitable. I want to get to a point where I can see the setups form real quick, looking at any time frame. The way you get to that level is constantly exposing yourself to back testing and watching live price action. You do not get it by overexposing yourself to risk. Because when you incur risk and you haven't learned how to do it properly yet, what is it? What is the subject matter I'm referring to when you haven't learned how to do it properly? Well, there's a number of things that encapsulate the it. It's number one, mastery of yourself, because you're never mastering the markets. I have not mastered the markets. I may look very, very versed in executions and managements and whatnot, but I still, and I can tell you that there's about 8 times this week that I would have lost. Whether it would have been a demo account, whether it would have been me calling it out in Twitter, if it would have been me doing it with a live account, I would have taken 8 losing trades this week. And it would have been no fault of my concepts. It would have been me trying to do something that I am, as a human being, prone to do. So when I say that, that's not a weakness, that's a strength. But because when I was a 20-year-old, I viewed it as a weakness. I viewed it as, I would lose on a trade and I think, okay, this makes me poor as a trader in every sense of the word. I have less in the account if I had the account remaining, or I'm less inclined to chase the next setup because now I'm scared. I don't want to incur another loss because I didn't come from money. And when I would take a $300, $400, $500 loss, those hurt. Like, that was a big portion of the account that I was working with. And it took a lot for me to get these couple $1,000s scraped up to refund an account, paying exorbitant amounts of fees and paying for all the little bells and whistles for the data and the software programs that I was trying to constantly build up and working with a desktop. And I see these people talking about it in their little fake documentaries. For the record, again, because there are people out there that try to say I have multiple laptops and they're all sitting in front of me, and I'm buying in one account, going long, and going short in another. I have one laptop, folks. I have one tablet. I have 8 monitors that runs on one PC, one tower. Okay, and I facetiously mentioned like a backhanded remark in the interview with Corbs. I said that my laptop died. Um, I had a Hewlett Packard. Okay, I had a desktop PC, and I had one computer with one big old monitor that literally is the size of a Yeti cooler. Okay, I'm trying to talk in terms where the younger crowd can kind of envision what it is I had. But I had all these things that I thought were high technology back then. And I guess in a lot of ways they kind of were. But today, you can do a lot of these things that we were trying to do and hope to do on your cell phone. And that's not the idea that you should be trading your cell phone, but you have more power in your cell phone to be able to pull up data, switch to one web browser tab, and have a multitude of things at your fingertips. And it's like a candy land right now of just going in and gathering information, collecting data. But that same thing is also overexposing yourself, looking at too many markets, looking at too many things that's going to complicate. I can teach you intermarket relationships. I can teach you intermarket analysis. I can teach you the characteristics that one market will lean upon on another. Okay. And I can do it in a wide array of ways where I can show you every instance of how a market will influence a commodity or a commodity may influence a specific market. And bond yeah, for 5 years. Market is for the effects of what you would expect in like SMT. There's a little bit of a delay that sometimes occurs with the interest rate markets, which makes it a little bit more complex to teach. And frankly, the way the world is right now, it's a market that I would not want to touch either. Because remember, I said I was leaving Forex years ago. I haven't been touching it. I went back to futures trading. Now, my heart is in the bond market, but I also am aware that that risk is high in the interest rate market because there could be a interest rate implosion and it could happen instantly and it could harm me. So what I'm doing is I'm focusing on a market that I trust, which is the index futures. I'm looking at a small universe of investment vehicles, meaning I'm only concerned about the S&P 500, the Dow 30, and the Nasdaq 100 composite index. That's it. I don't need the dollar index to trade any one of those. And to further simplify it, I don't trade the Dow. So what am I limiting it to? I'm looking at just the SPOOS market, which is S&P 500, and the Nasdaq Composite Index. And because I want to be in the market that's going to move faster, that's going to be exaggerated in its price swings. So what have I further done? I've reduced it down to just one market, referring to S&P like I would do what? The dollar index for a Forex pair if I was trading euro or cable. So I've simplified my observations in the marketplace. I've reduced my time in analysis. I could care less what all these other. I only do that because I'm teaching you, and I know there's a lot of interest in all the markets, and you all want me to do even more than that, and I don't have an interest or time to do it. But the things that I do in those respective markets, they're the same things I'm doing in any market I'm trading with, because it's not changing. The method is not constantly morphing into something new because I'm following another market or following another asset class. So overexposing is trying to do more than it's necessary, trying to find more setups than there really are there. And let's make a distinction between what I just said and what you're probably thinking. ICT, you said you can trade every hour candle and find setups. Yeah, I can. But just like I understand that my audience that's listening to me, I have a great deal of influence. And that's very intimidating for me. Some of you think that I like this position. I can't wait. There's 3 weeks left and I'm done. 3 more weeks, I'm not on Twitter no more. And this level of influence I have over many people who have a high regard of my opinion, high regard in me as a person and the things I'm openly sharing and for free and helping other people, that influence, that power, it scares me because I know what I was like when I was younger. And if I had Larry Williams constantly at a fingertip pushing a button, let me go see what Larry Williams is saying on his Twitter right now. At the moment, whatever musing that he had in his head at the time, if he's willing to share that, that would have been highly influential to me and me taking on monetary risk. Now, would he think about that level of influence and be guarded in his opinion? I don't think so because he was making his daily. I think he probably still does. I'm taking a great deal of liberty saying that. I don't actively follow what he's doing, but at the time when I was a younger guy, he made his S&P calls and maybe bonds and whatever else he would talk about at the time. And but you had to pay it through a 900 number. Okay, fine, whatever. But it was behind a paywall. I'm not behind a paywall. And I don't know the level of your experience. I don't know what you know about what it is I've taught. I don't know if you're a gambler. I don't know if you're reckless. I don't know if you just blindly follow anyone that says anything and you're highly influenced because you're just looking for any reason to scratch that itch. And because social media is what it is, it's an invitation for disaster because people that are not equipped to think independently for themselves, it's a wonderful grocery store for you to go out and pick the right person you think you should follow blindly. And I don't want to cultivate that. I don't want to have that in my students. I want my students to be independent. I want all of you to come to the conclusion that you don't need me. And my feelings are not going to be hurt by that. That's exactly the end game. That's the result that you're looking for, not the tetheredness of me and you together. And some of you see that as that's a problem. When that's just you growing accustomed to me as the man, the the figure, the person behind the ICT, the inner circle trader. You've grown accustomed to that person. And while that's wonderful in a lot of ways, I'm not that person for you as a mentor. The mentor in me is saying, you have to get out of the nest. You have to do this on your own. You have to fly on your own. And you shouldn't be afraid of that. You should be looking forward to it. It's not a tragedy. It's not it's not a drama that brings sadness. It should be like, this is graduation. And graduation may be fun for the moment, but it's scary too because you have to go out and do these things on your own and get new experiences without the hand holding, the everyday processes of being around your teachers and your other classmates, which makes it feel more comfortable. Even though you probably hated going through school, as an adult, 2 years out of school, you probably thought many times, man, I'd love to go back in school. I won't have to deal with these adult problems. Well, that's many times the same things that we experience as traders. It feels fun when you start to learn something new and your energy level is really high. Like if I went out there and said, listen, 2024, I'm doing a mentorship. It's 100% free. We're doing it every day, Monday through Friday on YouTube. We're going to sit down. I'm going to go over my charts. I'm going to draw the charts out every single day. And I'm going to sit down and I'm going to trade in front of you live every single day, the morning session, the afternoon session. Your activity level and everything else would completely stop. You would be making changes in your jobs. You'd be making changes in your curriculum at school and university. You'd be telling your spouses, listen, it's worth divorce. Everything's going to change because this is the opportunity that I knew would never likely happen, but here it is. He's doing it. And your energy level would go through the roof. Why? Because you see that opportunity to do more. And when you finally get to the point where you know how to trade, that shouldn't be like that. See, you think that it should be just like that. When I learn how to trade like ICT or ICT's best students, I'm going to outperform and I'm going to do this and this and this and this and this. None of my students with this new power they have thinks of their trading like that because they know they don't need to do that. That promotes overexposure. It promotes greed. It will invite fear because what you'll end up doing is you'll fear not controlling yourself. You'll become reckless, start making mistakes. You'll disassociate yourself from the model and the approach, and you'll revert back to retail processes, which is fear and greed, and analysis paralysis. That's retail thinking. In encapsulated form, that's it. So preventing overexposure is paramount. I knew when I gave the analysis before we started trading this week, I said, I'm going to put a limit on what I'm willing to wait for. And if I don't get this, I'm okay with not taking a trade. All week long, I'm comfortable not taking a trade. I wanted to see very specific things, and I don't want to kill the analysis and review that I'll be doing on Sunday, which will be live streamed, by the way. So we'll be living the market review at 5 p.m. and we'll see what the opening ticks are on all the markets, because I think we're going to see an extreme gap lower on equities, index futures. So, but anyway, having that observation of what's going on in Israel, what's going on in Gaza, and how all the other Arab nations are, they're getting rowdy. Okay, they're getting really jerked up and animated. Some of the bases, the U.S. bases, have been attacked. I think that's going to increase. And I think we're going to see a greater escalation in all of that stuff. And as a younger man, I looked at war, pestilence, famine, chaos, all these problematic things as cha-ching, that's an opportunity to get money. And that's how a globalist thinks. And when they see that you are good at that, you should have that. You should have no fear of these things, because ultimately, if you're wrestling with this as an investor, and I get this question a lot, and I promise this is not going to turn into a religious conversation, but it's appropriate for this moment for me to talk about it. I have a lot of students that are quote unquote Christian, and the number one question that comes up is, should they view trading as gambling because they are told that it's gambling and God won't honor or bless this because it's gambling? Well, there is a way to do this that's not gambling. Okay, the way I teach, number one, you're not trying to be reckless. You're looking for very specific things to qualify a setup. You're looking for things to quantify a setup. And also, I'm teaching you to do it with very little risk, not over leverage, not over leveraging. Do the least. Trade with a micro lot. $5 per handle in S&P, $2 per handle on the Nasdaq. That's very, very, very low in terms of the multiplier for a pip fluctuation, or not pip, but a 4 tick or 1 point or handle fluctuation in the respective averages. Now, if I say trade with 15 contracts and try to go for broke every single time, that's gambling. When I talk in Twitter spaces, I'm talking to you like someone that has been here before, has hurt himself, has learned from it, and has also helped other people avoid these same things, and they're profitable. Learning to do the things I tell them to do and avoid the things I tell them to avoid. That's how they got to where they're profitable. Not but Trading can be gambling in the hands of someone that's out to prove something. Out to prove something. Vendetta trading, revenge trading. What is that? That's emotional gambling. Everybody that goes out to those casinos in Las Vegas or goes to wherever the local place of gambling in your neck of the woods, wherever you're at, everybody goes there on an impulse. And anybody that says otherwise, they're liars. That impulsiveness is what? Rooted in emotion. They are feeling less than they should. They feel lack. They feel depressed. They want to feel better about themselves. And what else would make you feel better than winning some money? And that's why traders start in this industry recklessly plunging into it with no model. They race in there. The only thing they really want to learn how to do is how do I open up an account? How do I buy? How do I sell? How do I get out? And how can I get my money? That's what they're thinking is a mentorship. That's mentorship. That's mentorship. That's myopic mentorship. And there are dollar mentorships like that all over the internet, all over social media, because there's a new round of suckers coming in all the time. If I was a sleaze bag, I could be making millions of dollars every month fleecing those individuals. I don't need to do that. I'm here on my weekend telling you how to better improve yourself, think correctly, how to avoid gambling, how to avoid blowing out your account, over leveraging, and today's topic is overexposing yourself. Don't open yourself up to pursue more opportunities than it's really appropriate for you. Now, trading in an environment where there's going to be a lot of knee-jerk reactions. Now, what do I mean by that? Because ICT, you always say that the markets are not, going up and down and fluctuating as a result of buying and selling. No, it's not. Not because of our buying and selling collectively. No, it's the delivery of price by the central bank. Because that's the market maker. The New York Stock Exchange, that's not the hub that starts everything. Okay, that's just the face. That's the I nailed it. That's the face. That's who we think it is. Okay, all the prices come from there, and as a result of buying and selling pressure. Okay, if you want to believe that, that's fine. You're welcome to believe that. I have learned that trying to make the case that it's not that, I'm not going to convince everyone, and frankly, I don't care. And when you learn how to do this, you don't care either. It's funny to see these people run around believing the nonsense that they believe. But the central banks themselves, they are the masters of all this. They are the masters of money in every form of it, even your beloved cryptocurrencies. I should teach you, see what happened in Bitcoin? You said it's going to zero. It's going to zero. Okay? It's going to zero. I'm not claiming to know what every fluctuation is going to do every day. If I did, if I knew that, I'd be out here mopping the floors with all that stuff and all these crypto fanatics that follow people, whatever. They would follow me if I called those crypto markets like I call the Nasdaq and the S&P. They'd all be here, and I'd have more headaches with more drama and personality disorders and people that you don't want to go into this week. I accounts where I have lost, that I have beaten myself knowing better and soon still plunged ahead. And because I have such a large audience now, I have to be careful. I want to just take whatever I say because I have it. And I don't want any of you to think that. I want you to say, okay, this is what ICT said. ICT said this. Let me go in here and see if what he said is valid. Is this really there? I'm taking it back. That's how I started. That's how I started as a teacher. What I'm about to show you, in 1996, when I sat down with my students then, who sat with me side by side, literally, I don't want you to take what I'm going to say today and believe what I'm saying. I want you to go in to the charts and look for these things. If you can't see them, you come back tomorrow and you tell me that you don't see them. And I'll show you how to better identify them. Because if you can't do that part first, the rest of the week, and that's all they had with me is 1 week. Now think about that. I mean, look at all the content I have now. That's 30 years, and I have literally done a little bit less than, oh man, I think maybe a little bit over a quarter of everything that I know. That's what my compendium right now that's out there, and everything that's ever been done by me is just a hair's breadth above 1/4. And look how much has impacted the world. But also, look how much has caused confusion, caused competition, broken hearts, sore bums, people getting angry because no longer are they the flavor of the month. Because I'm not trying to be anybody's enemy and I want my life back. I don't want to be a celebrity. I used last week what I learned through hardship. I know that there was going to be movement in the markets this week. Lots of fluctuations. I knew there was going to be big movement. It means something. It's going to have it's going to act as no longer follows the natural processes. First metric would be this: risk off scenario. Right away, risk off is dollar up. Risk on, dollar down. Now, going back to risk off. Dollar index. If it's to go higher, if that higher dollar, if that is expected, or we think that we have little perimeter alarms in our house. No, if you insert that, and I don't want them to get noise, but one of them just went off, so I was waiting for my wife to turn. I'm not sure if you're this is one of the things I hate doing live stuff for a company. Will all move lower and bond market will go opposite. So wonderful. That's a symmetrical market. However, there are times where the characteristics of a market environment, which is what we're seeing right now, there's a lot of geopolitical wartime upheaval. There's a lot of opportunity for the central banks to build sentiment. And also, anyone that's positioned appropriately where they can stand to this environment that we're entering last week before this week started trading. Okay, so in other words, I'm referring to and reflecting on the on YouTube. You're welcome to go back and look and listen to it, okay? I outlined for me to be interested in trading for the entirety of the week. I wanted to see something unfold. I wanted to see the dollar index get above the upper quadrant that I outlined. And I don't want to say too much because I'm hoping if you haven't watched that video and analysis, go watch it because it's going to help you understand what I'm going to talk about tomorrow when we do our review and analysis for the new week coming. I didn't want to be so finite about this. This is exactly what's going to happen because I know that there was going to be decoupling, meaning that the dollar index can do one thing and the other markets can do another. So if I place a limit on myself and I can only engage if this happens, then I have a green light go. I can now start actively talking about the market. I'll start tweeting things and what I think is going to happen, and also add to it that, like I shared, the last 2 weeks, we found out that my mother-in-law is now battling another round of cancer. So my wife's, expecting me to be at her attention when she's asking for it, and it's very distracting. So I can't be on point with everything that I want to be as ICT, and it's also fitting because I'm reducing my exposure to you and conditioning you to expect how it's going to be when I'm not here post November 11th. So all those things coalesced into it would be easier for me to say, okay, if I could say what I require as a minimum for me to engage and talk about what I think is going to happen, then this is what I would look for. And I wanted to see the dollar index show me that, and by tipping its hand to me, if it went above and closed above the upper quadrant, then I wanted to then trust that the dollar index could go higher and continue going higher. Otherwise, if it doesn't do this, I'm not interested in it. And I can sit on my hands. And I'm telling you, and like I told you in that live streamed video, that I'm content with even having taken nothing for the day or the week because my mind was scattered. But my impulsiveness as a human being, the man in me, that 20-year-old that wants to get out there and do silly stuff again for the sake of just doing it, overexposing myself in terms of chasing the number of opportunities that I know that are there. And I'm going to go back to a comment I started the address. I didn't. I said, I know what you're thinking. And I mean, like, you think that I should be able to see more setups than the average person. And I can, and I've proven that. But I also have an influence factor that is now something that's in my head. So while I'm not afraid, obviously, to tell you what I think is going to happen, when I tweet it, it never gets deleted and it does what I expect it to do most times. Most. And I'm talking high 90%. Go back to my tweets and do the scale on it. It's an opportunity for you to do a homework session if you want to try to say I'm a liar. But because of the number of people now listening to me, and because I'm a human being and I'm wrestling with things with family, I'm wrestling with things with a spouse, and my attention's diverted. And on top of that, I'm literally following everything I can get my hands on in terms of what's happening in these nations that we're seeing all these things. And I'm not following the news. Like I have so many students that are literally reporting to me like on every 20 minutes I'm getting an update from them with real video of this is what's going on. This is what's going on and pictures and all. Like I got like boots on the ground there. I got intel in all these places. I don't look at the news. So when you're asking me, hey, can you tell me what news service you, I don't do that because they're lying to you. I have people that have relationships with me that are literally giving me the information firsthand right when it's happening, as it's happening. So because I have all that and I'm immersed in all of it, my attention has been on other things. And if I'm going to be distracted, and this is how you apply it to yourself. Okay, so that way it sounds self-centered, this discussion, but I'm telling you how I evolved from as a younger 20-year-old that would have all that chaos in his life, trying to pursue success, trying to keep a too young of a marriage, or not keep it, but to rekindle it because I was trying to earn my wife back. All these things I was trying to do, and also look significant in the eyes of my family and friends. All those extra things was overexposing myself. I was trying to do more than this is necessary, not understanding how to do enough and be content with it. Because if the number one reason why you're doing this is to make money, why not just simply reduce it down to what you're trying to do to make money and be comfortable doing it? While I have a lot of moving parts, I have a lot of PD arrays and things that could qualify for a setup for you. I don't use all of them unless I'm doing a trade on pyramiding. And every one that exists in that fractal price action, then I will key off of it to prove that it's there. But you can use this one thing, strip it down to a specific time of day around a calendar event that is going to be high or medium impact. And then that's it. That's all. And it's really simple. That's simple trading. But because I have so many weapons in my arsenal, you all want to be a man of war like me, where you want to just go out there and use all these things in your own hands. And you've not learned how to do one of them well. And that should be your pursuit. So because I had this expectation that obviously going into this new week, I anticipate acceleration and more of the things that we're seeing over there in the Middle East and Israel. The central banks will use that. They're going to use that sentiment that it creates, and they may or may not use the underlying sentiment to benefit themselves. Meaning, okay, if all these things accelerate and intensify, my experience, my co-signing in that analysis last Sunday in a live streamed review where 60,000 people were watching of it, I said, I don't think that we have topped in the dollar index. I think that we can potentially go higher. And because of all the uncertainty and the wartime things, I believe that the dollar will likely go higher, but it may need to go down into its daily fair value gap. And that's completely permissible. It's acceptable. That's reasonable. But even if it does that, I'm not saying I'm going long euro or cable because dollar index went down to its fair value gap. I'm not saying that. Now, I want you to go back and listen to what I said in that live stream. That can't be edited. People saw it. It's still there as it was said. When I said that I'm not interested and I would not be trying to go long dollar, which would be shorting euro and shorting the pound dollar, because if we're in a daily fair value gap, that would be at a discount for the dollar index. And if I'm bullish and I don't think the top has formed in the dollar index, that means what? Surface observation, just listening to that, and you've only been with me for a little while, you'll naturally assume that means I'm going to go long dollar and short euro, short pound dollar. At that moment, no. Go back and listen to what I said. I said, I would not be interested. I'm not saying that. Why? Because there's a decoupling. I'm expecting it to not do those things. I required the dollar index to trade up to a level it never traded to at all week long. Well, ICT, you sound like a hypocrite because here you are. You showed you made $50,000 in a trade on Nasdaq on Friday. I had the last portion of the week where everything was lined up. And I'm expecting the continuation of what I wanted to participate in. And truth be told, I wanted to be in on Tuesday. Like I wanted the short on Tuesday. But I said, I can't touch it. And if I don't do it, so over the next I'm going to show you. I was going to go in as my final model on the 2023 mentorship. It will be released on October 31st. I'll release it at 9 p.m. My local So what I employed on Friday with the Nasdaq was all based on using a market maker sell model. It is not Wyckoff. I'm going to smash everybody that thinks that this is Wyckoff. It is absolutely not Wyckoff. This is algorithmic. It's 100% matched to the buy side, what you expect to see on the sell side. You do not see that in Wyckoff. Okay, it's to the pip, to the point. It's very specific, repricing, redelivering. That's what it is. Okay, it has absolutely nothing to do with buying and selling pressure. It has nothing to do with retail logic. It has nothing to do with support and resistance. I anticipated that we would get this flash of rushing down and hit that sell side. When I was recording it, I wanted to see it like post 4 o'clock. I wanted to see it sprint down there and just go right down there and close below it. I made an allowance for that. But as we approached closer and closer, I was like, okay, I want to be getting out near the low. So I rolled that stop real tight and it allowed me to get out. But it didn't go higher much beyond that. And it didn't make a lower low either. So I'm content with how I managed that trade. I'm completely content with it. And I don't regret anything that I should have done as the trader that was correct on the times when I was briefly looking at it through my phone. Like I wasn't peeling over the charts with my monitors in front of me. Like I'm sitting in my recliner right now in my office and I have the screens in front of me. They're off. They're idle. Nothing's being on them right now. But usually when I'm talking to you, unless I tell you I'm out and about, I'm standing in front of this real estate of markets giving me a very diverse approach to seeing everything in concert, how all the markets are relating to one another, the dollar, Forex, oil, gold, everything that I would refer to as a intermarket relationship. I'm constantly getting all that feedback. Now, I also know through experience as a teacher that if I sit down with you and I show you, and some of you are asking this, and this is my response to this, okay? You want me to sit and show you and pan around and show you what's on my screens, okay? And what I'm looking at, why I'm referring to it. None of you are at that point where it's going to be helpful for you to do this because it's going to be too much information. You won't have the experience. You won't have the experience to ferret out the things that you're looking for. And quite frankly, I don't have decades to teach you the level of experience that's required to do what it is I'm doing. I mean, it sounds like a cop out, but at some point, there's going to be a knack that's required. And that was one of the things that was problematic for me as a teacher because I wanted to be able to teach everything. And there's certain things that I'm not allowed to teach, and there's certain things that I'm not equipped to because the factor of time, the factor of, you know, I may not be here tomorrow. I may not be here today. You know, today's not promised to me, and tomorrow is certainly not promised to me. What I've done is to the best of my ability, I've been able to share in a means of articulating what it is that I understand about price. It's proven to be effective because other people have taken that information and have made money with it. And they're consistently making money with it. And they're not being told what to buy and sell by me. None of my students ever get that. So when you get your results, you've done it on your own. And that's a testimony. That's what you're supposed to be looking for, your own results using what it is I've taught. And you should be encouraged by the other people that have done it. But looking at all the information and being able to ferret out the right way of interpreting it, understand that I am a human being. And if I see something in price action, well, let's just make it very plain and simple. Did the dollar index give me what I wanted to see as a catalyst for me to take a trade this week? No, it didn't. So if I was being dogmatic about it, I should not have taken that trade on Friday. Did I break a rule? No. I was operating as a mentor and also limiting my exposure because I identified the fact that number one, I'm human. Two, my attention is divided and it's being diverted to other things. There's a lot of things going on, and it's hot. Like all these things that are occurring over in Israel and Gaza and in the Middle East, that's a hot topic right now. I mean, good grief, I asked a Muslim a question, and they want to have holy war on me in Twitter when I just simply asked the question. So while I'm not afraid of any of that stuff, it's just unfortunate that everything right now is volatile. We can't, we can't even have a conversation about anything. So I know because of all these factors and what you're all incurring in your everyday to day life, things are expensive. You want to be able to do this faster, and you're going to blame me if you make a mistake. You're not going to own it. I placed a limit on me as a mentor, saying, okay, for me to talk openly about what I think is going to happen, it's going to require this. Then I'll take a trade. I'll show you something based on this information here. But as Friday came, and I'm looking at price, and I'm like, man, I'm teaching on the market maker models this month. It would be horrible for me to let this go by and only talk about it in a review on Sunday after the fact. So I wanted to have something, and I wanted to make up for not having done anything all week. So anybody out there wants to do the scaling and measuring of, mine's bigger than yours type thing, I did your whole month in one trade. And that's if you were doing it with real money. So that logic that I used in that trade, that is incorporated in what I teach is my market maker buy and sell model. That was a sell model. Okay. So if you want to get a preview about what we're talking about, I encourage you to go over to your Nasdaq chart. Pull up your Nasdaq for December 2023. And I'm doing this from my phone because I don't want to turn my screens on, because I know if I do this with my main screens, I can turn this into a 6-hour session today. Do it, ICT, do it. I'm here for it, right? All right, so you want to go to NASDAQ, go up to a 4-hour chart. Some of you are like, I knew it was the 4-hour chart. I knew it. So if you look at your 4-hour chart on NASDAQ, December contract, and if you put your, give me a second here. You put your cursor or your mouse or whatever on the low ahead of October, and that would be on the 27th of September, Wednesday. Low. I'm waiting for these guys to do it on YouTube. Listen to them, because the guys on YouTube, they got Twitter Spaces and they use their own charts and whatnot. So it makes it interactive, which is cool. I ain't got anything to hate about it. Then you have October 4th at low. Okay, so you have relative equal lows there. So if you look at what price was doing between the 27th of September and October 4th on NASDAQ, that is what is referred to by me as the original consolidation of the market maker sell model. The high that was formed between those two lows on the 29th of September at 10 a.m., that's the high of the original consolidation. So that little trading range there, when I'm looking for a reason to go short, my highest probability trades, and folks, this is the part of these discussions where if you don't write it down and then take what I'm about to say and go back into your old data, your old charts, your old setups where you lost money, you're going to see that it was not there. And yeah, that's the reason why you lost. That's how I discovered it. I looked at everything that I was doing with real money, and the things that constantly kept repeating because I wanted to know. I wasn't trying to hide myself from it. I wasn't trying to shield my eyes and say, oh, I made a mistake. Let me pretend it's not happening and find fault with everything else except for myself. Now, there was a period of time when I was like that, but when I realized that this was never going to let me go, I was infected with these things, these markets. So I have to either learn to live with them productively and profitably, or I'm going to live a miserable existence, not being able to figure out anything to do anything with it. So my observations were every time that I wanted to be a buyer or seller, when I finally figured out short selling, because it took me a long time to trust doing that, if I was going against what I'm about to outline here, I failed. So the problem because results and bar to be perfect, you're in one tree. It's just going to have an hour funded account and you blow it. That's how I traded as a 20-year-old because I needed to get out of the life I was in. I hated it. I hated it. I was on the 4 hour and the 8 October 4th low and the high on the 29th of September. You want to draw a rectangle on that. You'll make something that it will get real close to it and stop. Perfect example. You know, don't change the chart. Stay on this 4 hour chart for Nasdaq. But I shared openly what I felt that the gold market run for the buy side. And for the fellow that said, you want to make money, fade ICT, go short gold. Woo! How about that, baby? Got your ass toasted, didn't you? Oh, I love it. I'm going to miss that much. I'm going to miss that so much from Twitter. Some of you got your earphones blown out, right? Whatever. It's live, baby. And sometimes it's going to happen. I've been talking long enough, okay? I've been talking long enough, and it has to swing the other direction, right? But that original consolidation between the 27th of September and the October 4th low, that consolidation creates and engineers sell-side liquidity or sell stops below those relative equal lows, okay? And if we're expecting price to go up to some premium array, some reason to go up, okay? Now I'm going to use very specific, generic, retail terms so that way we can talk, because I don't know what level of experience you have with me. I don't know if you're watching this on YouTube and you found somebody that's taking my Twitter spaces. I don't have a problem with them doing it. I just don't want you taking my analysis or teaching videos and putting them up on your YouTube channel because I will tear your whole channel down. And I've done it, and I have a few of them. You're about to lose somebody, you're going to lose your channel because you're monetizing my videos. I don't go for that, and I'm going to take your shit down if you do it. And no, don't email me and ask me to take away the copyright because I won't. If you think that the market's going to go up to some retail resistance level to offer a shorting opportunity, I don't subscribe to that. Okay, I don't view the market like that. I believe the market's going up to a premium, specific premium PD array, a imbalance, or liquidity above where the original consolidation was trading. Okay, so we're expecting price to go up, to go lower. Where should it go to on the basis of declining? Right below those relative equal lows at September 27th and October 4th respective lows. That liquidity below there, they're going to want to engage that. It might not do it, but I believe we're going to gap down and open below that on Sunday. I believe that's what we're doing. Or we're going to open up lower, fancy dance around the open at Sunday, and then reach quickly down below those lows. One of the two things are going to happen. I personally want to see a gap way down there and open below it. That's what I want to see. Now, what I want to see is irrelevant. What I want to see should have no relevance over your trading and your trade decisions. But my experience, what I want to see as a trader, what I want to see as an analyst, what I would expect, that something's going to happen today or has happened, and we don't know because the internet's down in Gaza, northern Gaza. There could be all kinds of atrocities being done, some kinds of escalation. We have Sunday still before the opening. A lot of things can happen. Shocking things can happen. We're in that climate where things like that can occur. So these central banks will use that sentiment, that shift in fear, which I'm not a fear monger. I'm telling you how to master yourself in these environments. I'm not teaching you to be fearful that the boogeyman is going to get you. So I block people that do that. When they say I'm fear mongering on Twitter, you're a fucking asshole. Get the fuck out of here. I don't want to hear from you. I don't want to see your tweets. Go talk that bullshit somewhere else. I'm teaching you how not to be fearful. These things, I can't change them. You're not going to change them. You're not going to stop that war. America's not going to stop that war. Israel's not going to talk nicely and say, okay, we overstepped our boundaries. And the Palestinians are like, okay, we forgive you. And the Palestinians are not going to accept Israel in any capacity. So there's no solution. So we all have to deal with it. Every nation's going to have to deal with it. The markets are going to use it as a sentiment. It's going to cause all kinds of ramping up in volatility. So you have one of two choices. Don't trade at all or learn how to navigate it. And I'm teaching you how to navigate it. You don't have to like or even subscribe to the things I'm teaching, but don't come to my fucking shit if you're not trying to learn because you're wasting your time. As soon as I see something that's offensive that I know that you're not trying to learn, I'm going to tell you pound sand, get the fuck out of here. So I'm not fear mongering, nothing. But I want to see it gap down below those relative equal lows on Sunday because it will be a confirmation that we're going deeper into that daily buy side imbalance. Remember I was highlighting that a month and a half ago about that is going to be the quarterly shift target. Thanksgiving. I told you. I think if I'm correct, and I am 51 now, so I might be having a senior moment. But don't take my word for what I'm about to say. Go back and listen to the analysis. Go back and read the tweets. I'm not getting any money for you looking at old tweets. I believe I stated that Nasdaq by Thanksgiving we should be down there in that buy side imbalance on this daily chart. Well, we're a little bit past midpoint of October. We have a couple weeks left. A lot of things can happen between now and Thanksgiving. And we're fastly approaching those relative equal lows on the daily chart on S&P and Nasdaq. There's real liquidity down there. The folks that thought that October low, that fall low is in, I told everybody there's no reason to own equities. There's no reason to own stocks. And where's the clowns that were talking some shit? You're getting eviscerated right now. That October low to me was suspect. It was like a fake trust it. And how do they make you trust it? Putting in fake pseudo support, double bottoms. Well, if you look inside that consolidation, go to the right of it, you're going to see that there is on your 4-hour chart, the 10 a.m. of October 6th. It's Friday. There's a fair value gap there. In that fair value gap, extend that over to the right. To the right of the high that forms on October 12th. All of this discussion is germane to the 4-hour chart of NASDAQ. Okay? And you might think, or might be thinking to yourself, man, I trade Eurodollar. You need to get off of this stuff. Talk about Euro. No, I don't. What I'm talking about here applies to every other asset class. It's not limited to just this. This is what price is doing. I'm trying to teach you to learn how to trust the language I've been using. there's a thing that constantly, reoccurs over and over and over again, and it's the repricing to liquidity or repricing to inefficiencies. That's the market truism. That's the truth. It has absolutely nothing to do with the amount of buying and selling pressure. It doesn't lean on the logic of anything else out there. That's all the market's doing. If it's not doing that, it's consolidating. In the rare instances, and we're probably going to see more of these instances start popping up here in the coming weeks and months, you're going to see manual intervention, where you're going to see these sudden boom. Where did that come from? Perfect example, last week, look at your Japanese yen. In seconds, it moved 100 pips, and then erased it. It looked like it was a data error. It looked like, what is this? Then you go across all the brokers, and they all had the same thing. That's why I tell you, I don't trade yen. I do not trade that currency because it's absolutely highly manipulated. Swiss franc is too. And gold is equivalent to that. It's the event-driven market, but in wartime scenarios, you can see gold moving around a lot. But that fair value gap that I just mentioned on the 4-hour chart, if you extend it over to the right, it's going to behave like a point of magnetism. It's going to draw price into it again. It's going to act as a means of collecting interest, pooling interest into that range of that fair value gap on the basis of an inversion fair value gap. Now, if you have been listening to these long-winded rants and dry conversations, not over a chart, but in Twitter spaces, if I was a college professor and I was teaching a lecture and you paid for this course because it was part of your major and you actively wanted to learn, you would be literally writing down everything that I'd be talking about because you want to maximize the time with this professor or this teacher or the lecturer. When I sit down with these Twitter spaces, I'm not here twiddling my thumbs and talking for the sake of hearing my own voice. I'm telling you the things that you should be listening for and then writing them down like I'm going to say here. If I see a PD array that my interest is in and I expect it and it's usually willing to go back up to it if I'm bearish, if it trades up to a fair value gap. Okay, does that fair value gap create the continuation of the theory that I think that the market will go lower? Or is it performing inside that fair value gap and overshooting and then closing above it? There's a decision to be made there. But what happens, and what did I say, if a PD array can't be even reached? If you can't reach it and you're bearish and it's going up, but it doesn't get there, it just falls short of it, and then all of a sudden starts showing you what? Order flow is heavy and wants to go lower. What does that mean? That means it's decidedly weak. It can't even get back to an inversion fair value gap. So if it can't accomplish that, we're really heavy. We're really heavy. And late in the afternoon yesterday, around 1:30, I was looking at it rallying. I was like, okay, I know what this is. I'm shorting that. And I shorted it into a breaker. I'll show you in the review on Sunday. But I was using a breaker as the basis of it, and then I pyramided into it, and then it created a new lower fair value gap. I traded into the return of an impulse leg lower. I was trading that first return in, which I knew was probably going to be a fair value gap, and then I went into it again and added more, and then I didn't get that sell side delivery. I really was expecting it to do it after 4 o'clock, like accelerate another 100 handles, which would have been like, wow, did you see what? I was waiting to see that in everybody's tweets, like, wow, where'd that come from? And then I would have been sliding in saying, check this out. But it didn't do it. But either way, it was a matter of me being able to use the information I'm going to be teaching you that is in the marketplace. Every single week it's there. Every time frame it's there. But I like a second stage redistribution on a market maker sell model, and or I like a second stage re-accumulation in a market maker buy model. Now, a market maker buy model, a market maker buy model is a reverse of this. So the market would be creating consolidation, dropping down into a discount just simply to go higher, to go above the original consolidation. Here, on this 4-hour chart, the structure is a 4-hour market maker sell model. Now, if you look at the high formed on October 12th, and on your 4-hour chart, it should be your 10 a.m. candle. That is a smart money reversal. And then you can see the low risk short forms on the October 13th, 6 a.m. candle. And it's trading right up into the fair value gap that formed October 12th at 10 a.m. on that candle. And then we have the first stage distribution on October 16th, which is the 2 p.m. candle. All of this is relative and germane to the 4-hour chart still. And then we had a lot of consolidation in there. And then finally it dove down. And then we have the second stage redistribution at 10 a.m. Thursday, October